Thanks to the renewed concerns over Eurozone stability this morning, there is a bid for Treasuries. But it may be short-lived because Treasury yields have been trending higher after the White House forged that deal on the new tax bill, one that injects more government stimulus into the U.S. economy. Tom Tucci is head of U.S. government bond trading at RBC Capital, one of the 18 primary dealers that trade directly with the Federal Reserve. He's got his finger on the pulse of the market, and in particular, flows. We're going to find out what your clients are doing. Tom, are you surprised by the firmness of the bid for Treasuries this morning? Because we've had some Eurozone instability. There have been constant concerns. Or is this really just the consequence of Moody's action on Spain?
Well, I mean, there's just been a slight lift if you look at where markets went out yesterday. So in general, to me, it really hasn't had that big of an effect. I think it's a temporary event anyhow. We've seen a severe amount of liquidation take place as the market's repricing itself to a stronger growth outlook going forward in 2011.
All right, so what is it that your clients are doing? How do they feel about potentially value with Treasuries trading in sort of the 3.25 to 3.4% neighborhood? Or do you feel as though they see the injection of stimulus through the tax bill as a reason to continue selling?
No, it clearly is a reason to continue selling at this juncture because the market never anticipated this. I mean, just a month ago, we were still talking about deflationary trends and the economy possibly rolling over. You know, the Fed instituted its QE policy, which provided some support, and the market kind of, buoyed itself. But in general, this tax cut is a significant factor that the market had never priced in, and that's what we're doing now. We're moving the rate structure to a much higher level in order to incorporate that growth forecast.
Okay, so Tom, what's the conversation between your Treasuries desk and your fixed income investors? Is there a consensus on where there is value on the curve right now, on the yield curve?
Not right now. In fact, we're in the middle of a liquidation phase, and we can talk about levels that we think that may make sense as far as a value judgment, but you've got a couple things going here. You're going to have uncertainty over the next couple of months because, as far as I'm concerned, the next couple of months will, be a pattern of economic growth that will not be what it will be going forward. And what I mean by that is this tax cut situation, we won't see the full effects of that until probably the later half of the first quarter. So we're kind of in a 2-month period window of economic data that will be what I would consider secondary. We know that things were relatively slow. They've started to pick up, except for unemployment. That seems to be the big lagging indicator that has been a focus of the Fed. They mentioned it yesterday. But in general, we're starting to see people start to forecast a much more significant growth path for 2011 as it relates to the stimulus.
So in your mind, it's growth. It's not the concern over deficits, but the anticipation of growth that's backing up yields.
Right, because if it was deficits at this juncture, and I'm not ruling that out eventually, but if it was deficits at this time, the long end of the market would be getting hit more than what's happening to the rest of the curve. The selling has been taking place in the area that people have been long over the course of the last 6 to 8 months, which is the middle of the curve, the 5 to 10-year sector. So those are the sellers that are in the market. They're the ones that accumulated positions over the last 6 to 8 months, and they're the liquidators of the market right now.
All right, Tom, thanks very much for the perspective. It sounds like the bond vigilantes really have yet to show up. That's Tom Tucci. He is head of U.S. government bond trading at RBC Capital.